Interesting day overall. I think the most fascinating thing is the daily chart. And if you look at the daily chart, let me first make sure that the audio is working. Okay, looks like the audio is working. So anyways, the one thing, well, first, let me actually go to a weekly chart. So this is what's interesting. The bears are hoping that we have a double top and we break below the neckline and we fall for a measured move. I don't think it probably won't happen, but you look at this, it's definitely a tight trading range. And you look at that and you think, what's the probability that we have a double top? You can also call it a triangle if you want. 3 pushes up, 1, 2, 3. And we're going to break below the neckline and fall for a measured move. At the moment, probably not going to happen. But if today's Thursday, if tomorrow closes near today's close, especially if tomorrow is an even bigger bar, it would increase the chances. At the moment, it looks like we're going to break below the January 17th low. So anyways, the bears want the break below the neckline, and they want the market to fall for a measured move. Probably won't happen, but you never know. I want to check something. So 1675 and 2550. It's hard to see, but we actually have a gap right here. It's a breakout point. And breakout points typically get tested. And you can see it's really small. It's hard to see. It's a 9-point gap. If we sell off, if we form a double top, break below the neckline, and sell off down here, we will effectively close that gap. Daily chart, more or less the same. We have the double top here. We're trying to break below the neckline. We already have broken below the neckline of February the 3rd. Now the bears are trying to break below the neckline of the January 13th high. So this is what the bears ultimately are hoping for. Bear breakout, measured move down, and a test all the way back down to the September lows from last year. We had a low one short yesterday, and I made a comment on the blog that it's really common whenever you get a low one like we did yesterday. It's fairly common for the market to pull back and then get trend resumption. And I thought two things. One, I thought there were probably buyers below today's low. And if you look back at the chart, there were buyers below today's low. The market, so I thought the market would at least, let me say it differently. I thought the market would likely pull back. In other words, there would initially be buyers below yesterday's low. The market would pull back, and then we would get an attempt at trend resumption. I did not think today would be as strong of a bar as it was, but we had a tight bear. So what I thought was going to happen is the market would pull back, worst case form a trading range, and then test back down. However, this can happen sometimes. If you're a bull, let me go to so remember we had a low one here. Let me go to a 5-minute because it'll actually be easier to explain on the 5-minute. So this is yesterday's low one. It's right there. And you can see on the open, the market gapped up far above the low one and then sold off relatively quickly, triggering the sell on the daily chart. And then the market rallied for several bars, tried to trigger the low one again, rallied again. And then ultimately, we broke below the low one and sold off by a pretty good amount. So right now, you have bulls that are trapped. They bought the low one, they scaled in lower, and they're in a little bit of a situation here. We have a sell climax today, increases the chances that tomorrow is probably not going to be a second strong bear bar, but clearly we're in a trading range. So I do think we'll probably fall below the January 13th low. Why do I think we'll fall below the January 13th low? Well, if you're a bull and you buy the close right now and you put your stop one tick below January 13th, you know the odds are you're going to get stopped out. The risk is small. And whenever the risk is small, that increases the probability that you're going to get stopped out. You know, the bulls, they have great risk reward, small risk, and the reward is all the way up here. 5 minute chart. As I mentioned, we gapped up on the open and bar one formed a doji. Typically, bar one at any given point, on any given day, bar one has a 20% chance of leading to either the high or the low of the day. So when you see bar one have a tail above the bar, you know there's a 20% chance that it's going to lead to a trend from the open. And 80% chance we're going to fall below the low of bar one. Two, we broke above one and then we started to sell off. Strong enough reversal, probably going to fall below one. We have a gap. We're probably the gap's not that big, and most of the time the gaps close. Most gaps close. Therefore, the odds are we're probably going to pull back. Want to fix that. And then three, relatively strong bar closing on its low, but a tail below the bar, closing far below two. Climactic bar increases the probability that we have to pull back, but I suspect there's still traders selling the close of three and scaling in higher. Now, as far as realistically selling the close of three, some traders will, but when you have a tail below the bar and bar one and two are bull bars, and you look at the price action, if you take away bar three, then it's mostly a trading range open. That makes me think we'll probably pull back. And that was the pullback. The bears sold the close of three. They scaled in higher. You had other traders who looked at this bar and sold 50% or the midpoint of the bar. Some bulls, they bought below one and they got trapped during three, and they used the bounce on four to try to avoid a loss. But, anyways, four, low one short, probably buyers below initially, and then a second leg down. Again, low ones, they typically lead to buyers below. They pull back for a bar or two, and then they get a second leg. The stronger the breakout, the faster the bulls get trapped. What do I mean by that? The stronger the breakout, if it's a really strong breakout, like here's a low one, 40 on 40 yesterday, and that's a breakout pullback sell, but it's following a consecutive bear bars 37, 38, and it's breaking out below a trading range. When you get a low one like that, it'll often just quickly trigger and immediately go down. Here, we may have to pull back and then try and get a second leg. And you can see instead, the market pulled back for a small portion of the bar, and then it sold off relatively quickly. And that was to be expected. I didn't think we'd get as strong of a bar on bar five as we did, but I thought at a minimum we'd get a second leg down. When you see bars like three and four, you know the odds are we're probably going to go below yesterday's low and trigger the low one. So as far as selling the close on bar five, plenty of traders will. Others, they'll wait to see what the follow through looks like, taking a chance that they can sell a pullback after bar five. We had bad follow through on four after three, so chances are bar five is going to have bad follow through on six. And instead, it went straight down to the close. And that's a warning that obviously bears are selling. Whenever traders see a strong breakout like this, most of the time the market will pull back. And when it doesn't, it traps traders. Let me just get a sip of water really quick. So strong bear bar, is it sell the close? It is sell the close, but you're right at support. And therefore, the bears that are shorting or that are short, they'll probably begin to exit on disappointment. And you can see what happened on seven. Seven was the disappointment. You had traders selling the close of 6, and then as the market broke below yesterday's low one, yesterday's 50 bar 56, it sold off and started to pull back. And because the risk is getting big for the bears, this increases the chances that the market's going to pull back for a couple of legs. And therefore, a lot of bears that are short will be fairly quick to get out. We had a bull bar on bar 8. It's a low one, but it's a low one at a sell climax at the low of the day. Probably buyers below. And you can see traders were not expecting bar 9. 9 was enough of a surprise that it increased the odds that the bulls are going to get at least a second leg. So you have a lot of bears giving up here. Now, the one thing to realize is 7 is a strong breakout and 9 is a strong reversal. Typically, it's really common when you see a bar like 9 to, traders naturally hope that the market's just going to go straight up to a new high of the day. And that's possible, but it's not likely. What's more likely? A trading range. The bears who sold down here, as long as they don't panic, they're probably going to be able to avoid a loss. Now, a lot of traders, when they see 9, the smart thing to do is to exit shorts because they know bulls are going to buy at least temporarily. 10, we have a bull bar, follow through for the bulls, good for the bulls, but the follow through is a little bit smaller than 9, and that increases the chances that whatever rally we get may be limited. And then we got a relatively big bull bar on 11 and testing near the high of bar 10, the start of the channel. We had a bear breakout 3, and then the high of bar 4. Let me back up. I always get a little tired around this time, and sometimes I reference the wrong bar number. But anyways, bar 4 is the start of the channel, and we tested it here. We had a spike or breakout on 3, tested, we pulled back to the top of the channel 4, and we sold off. The point I'm making is we have a big bull bar 9, smaller follow through 10, and a big bull bar 11. That increases the risk that this might be some sort of parabolic wedge. Parabolic wedges are really common in trading ranges. Now, I know what you're thinking. How in the world can that be a parabolic wedge? Well, the market rallied on 7, paused on 8, and why did it rally on 7? Because it sold off and then rallied on 7, paused on 8. Then we had an increase in momentum on 9, and then we stalled on 10. We have smaller momentum. And then we have another increase in momentum on 11. An easy way to prove that to yourself is to try and draw a trend line. And you can see if we try and draw it, the trend line naturally gets steeper and steeper. And therefore, you know that it's parabolic. A lot of bears, you have some bears who stay short and they'll look to add on to their position. They're not going to add on as 9 is racing to the upside. If anything, they're going to buy back their shorts and then look to sell higher. Some bears, they'll stay short and they'll wait for the market to begin to go sideways and stall. Market starts to go sideways and stall, they'll start selling aggressively. So what does that mean for the bulls? Bulls that are buying here, they're buying a minor reversal, big down, big up. And it's possible that we get all the way back down to the 8 high or the 7 high. So it's really, even though this is bullish, I don't know if it's the problem is that this is pretty bearish as well. And so you're buying something with a lot of risk. If your stop is all the way down at the 9 or 7 low, and you're probably not going to make 1 times your reward. And what that means is traders will be quick to get out. 12, we have a doji, a bear bar closing above its midpoint, so it's a doji. It's an inside bar. You can call it a high 1, but not many traders are going to buy above that high 1. It's kind of like the opposite down here. Not many traders are going to sell below the low 1 on 8. So as far as buying above 12, I would not, even though I think we probably will go above the 11 high. This is an area where the bulls originally got trapped. 13, strong enough surprise down that we'll probably get a second leg down, but we have a big bar on 13, closing on its low with a big tail below the bar, following a big rally up to 11. Bulls, if they bought the close of 11 or they bought during 11 and they scaled in lower on 13, you know what I'm going to say. They're probably going to make money. Again, high 1s and low 1s typically pull back and then get an attempt at trend resumption. And you can see it happens all the time. Low one, short 69. The market pulled back. The market triggered the sell in 70, pulled back, and then it tried to get trend resumption. We have a high 113. The market pulled back. It's probably going to try and get trend resumption. And you can see the market tried on 14 and went outside up. For the bulls, outside bar, relatively big bar with a tail and a lot of overlap. Not really an ideal environment for bulls to be buying above. And you can see we went sideways with 15. 15 inside bar, trading range price action. And then we started to go sideways some more and we broke to the downside on 17. 17, second leg down after 12 and 13. Bulls want a double bottom, 14 low in the 17 or 18 low, and they want to reversal up. But the problem was there's a couple problems with 17 for the bulls. One, 17 is a relatively big bar and it's breaking out of a tight trading range. And that always increases the risk that the pullback could be a lot further than what seems reasonable. And then we got follow through 17 and 18. Because it's consecutive bear bars, we'll probably get another leg down. And we may end up forming a wedge bull flag. So first push down 14, second push down 18, third push down somewhere over here. But generally speaking, as far as buying the close of 18, even if 19 pulls back, I don't think buying the close of 18 is all that great of a trade. You will have bulls buying it, betting that 19 is bad follow through. But as far as buying it for a swing, I'd rather wait for a decent reversal bar. Then you can see what happened with 19. There's a few things. One, you had bulls buying the close of 18 and they started buying the reversal up, and then the reversal up got too big. And once it tested the breakout point 16, where bulls got trapped on 17, they started selling. And you had bears doing the opposite. Once the market started testing the breakout point 17, bears started selling, betting on a reversal back down. And then we have an inside bar on 20. For the bulls, you can call it a second entry, but a lot of overlap 18, 19, and 20. 20 has a big tail above the bar. Probably not a great stop entry buy. In 21, it led to a strong breakout. For the bulls, good for the bulls, probably going at least a little bit higher. And then you can see 22 follow through for the bulls. The bulls and the bears, instead of getting 3 pushes down, they got 2 legs down. But in any event, this was strong enough for a second leg up. Why did 21 reverse up so quickly? There's a few reasons. One, you had 20. It's not a great buy for the bulls above, but it's also not a great sell for the bears. This is likely to be a trading range, and we're probably lower in the range than higher in the range. And because of that, there's added risk that we rally. Big bull bar 21, probably going at least a little bit higher. Follow through 22. What about buying the close of 22? You can, but look where you are. You're at the top of a trading range, and you have disappointed bears, disappointed bulls who bought in here, got trapped. And what are they going to do over here? Some of those bulls will look to exit. 23, reversal down. You can call it an expanding triangle if you want. Not a great shape, but it is. We went down on 11 and then up, down on 13 or 14, up and then down on 18. And then we have a strong reversal up 21. So 3 pushes down, 2 pushes up. You can also just call it a double top with 11 and 23. Because 23 is closing when it's low and reversing the follow through, I think it's certainly okay for the bulls to exit. Low probability that it leads to a double top, break below the neckline, and we fall for a measured move. But right now, big up, big down, or big down, big up, big confusion, and that often leads to a triangle. Decent reversal bar, 24. Big bar, big risk. So some traders, instead of selling the close of 24, they'll look to sell a pullback, and that's what happened with 25. But as far as buying 25, I would not after 23 and 24. Second leg down, 26, but a low one short. Not a great sell. Possible test of the 24 close. You have bears who sold the close, disappointed getting out break even. But realistically, we'll probably get a second leg down after 23 and 24. And it's a possible second leg trap, rally to 11, pull back, second leg up 23 high. And that increases the risk that we test down to the 19 low. 27 triggering the low one, decent entry bar. We still may pull back for a bar or two, but I suspect we'll probably go at least a little bit lower. And then 28, we have a bear bar, but a smaller body. You can argue the momentum is getting weaker for the bears, but it's not a good stop entry for the bulls either. And that's why the bulls gave up on 29 and we broke to the downside. For the bulls, it's a bear breakout below the neckline. So we have a double top break below the neckline. They want the market to fall for a measured move, which takes us back to the low of the day. Follow through on 30, good for the bears. But whenever you break below the neckline of a double top or a double bottom, it's common for the market to pull back into the trading range and form a triangle. So we could pull back here and still get the measured move down. Bull reversal bar 31, good for the bulls. Even though the channel's tight, it's arguably a parabolic wedge. It's at least 2 legs down with 24, pause, and then second leg down 30. But you can also argue that it's 3 pushes down 24, 27, 30. You can also argue that it's a bear channel 14, 18, 30. Decent reversal bar 31, but the channel down's tight in a micro channel from the 26 high to the 30 low. Probably sellers above. But as far as selling it, not really a great environment. Look where we are. The bears who sold the high of 7 and more higher, guess what? They were relieved of their bad trade. And that increases the chances that those traders are not going to be interested in selling again. Low one short, breakout pullback sell on 32. Good for the bears, but a possible double top. So we may trigger the sell and try and reverse up. And then we got a doji 33. Not a good buy signal bar for the bulls. Even though we're at the bottom of the trading range, the channel down is fairly tight. And while I do think we'll probably get back to the 18 low sometime soon, I suspect that there's probably sellers above and we'll at least have to form a better double bottom. 34, bear breakout, good for the bears, but becoming climactic near and breaking below yesterday's low again. I suspect bad follow through after 35, or excuse me, after 34. 35, strong enough reversal up, probably going to go at least a little bit higher. And then 36, strong bull bar, good for the bulls, but disappointing. The bulls who bought up here quickly got trapped on 24 and it got 2 more pushes down 24, 30, 34. Even though 36 is a strong reversal bar, it's around 50%, and that increases the chances that we go sideways here. But good bar for the bulls 36. I suspect buyers below scaling in lower. And then something important happened with 37. 37's follow through, but it's a loss of momentum. It's not. This is so. Let me put it like this: 37 bear bar, 38 strong bear bar, but it's closing below a lot of bars to the left, and then more follow through, closing below a lot of bars to the left. What did 36 close above? 36 closed above the past 7 or 8 bars, but it's not above all the bars to the left. And whenever you're in the middle of a whenever you're in the middle of a trading range, that always increases the risk of a deep pullback. And therefore, while you may have some traders buying up here, some traders will try and buy at the breakout point, betting that the bears who sold and scaled in will make money. And then we have a 38, a bear doji, you can call it a bear reversal bar. And because we're in a trading range, we may test all the way back down here. So the bears are hoping this is a breakout pullback sell setup and that we reverse down strongly below 35. Probably won't happen. If it does happen, I suspect there's buyers below. And then we got a surprise 39, good for the bears, probably going at least a little bit lower. But because of the tail on 39, that little bit lower might be one tick below 39 on 41 or 42. 41, low one short, but not a good sell below the bar. Doji, so probably buyers below. But the odds are high. We're probably going to fall at least one tick below 39. And you can see, let me see here, 50 and a quarter, 50 and a quarter. So in this case, we did not fall below 39. However, we formed a micro double bottom at an important area, the breakout point of 35. So you're at support and you have bulls buying. And this is really not ideal for the bears. I think 35 and 36 are strong enough for a second leg. And we have trapped bulls from over here. Bulls bought the close, disappointed. So some bulls, they buy here, they buy more above a bull bar, they get out break even. Other bulls they hold their position, taking a chance that they can get out back their original entry. And then 43 bull bar, but close under the midpoint. Not ideal, but probably buyers below. 44 doji. And then we broke to the upside 45. Good for the bulls, but a possible wedge 41, 43, 45. But breaking out of the neckline of you can argue a double bottom. 2 legs up for the bulls, middle of a tight trading range. Probably going to go at least a little bit higher. But I have to say, I'm not all that thrilled about buying the close of 45. 46 doji, bad, sell below the bar, so probably buyers below. And you can see we rallied for 148 and sold off 49. 49, you can argue 2 legs up, but tight bull channel, so probably buyers below and sideways. But as far as buying below 49, you can argue 3 pushes up in a spike pullback channel, testing the top of this channel. So we had a spike down to 24, pullback, so you know the start of a channel, and then a sell off, and we're testing the top of it right here. So arguably, we're at resistance. Bull bar 49, breakout pullback, buy setup. But there might be more traders selling above 49 rather than buying it. It's really not that great of a buy. And then a doji 50, it's an inside bar, probably sellers above and a second leg down. 51, bear bar, breaking out of the tight trading range. Good for the bears, but better to see follow through. And then a doji 52. But when you look at 52, you can argue it's a second entry with 49, 52. But think about those 2 stop entries. 1, 49 didn't fail to trigger the buy above. And that's because too many traders were interested in selling above 49. And then 52, a bull bar, which is theoretically a second entry buy, is a doji. So it's a relatively weak bull bar for the bulls. And that increases the chances that there's sellers above and we go lower. Outside up 53, good for the bulls, probably going at least outside up 53, good for the bulls, probably going at least a little bit higher, but we're in a tight trading range, and buying 53 is buying in the middle of a tight trading range, and that lowers the probability for the bulls. And you can see 54. So we have outside up 53 and then outside down 54. So it's an OO. You can call it an expanding triangle pattern. And that typically increases the chances that you're going to get a second leg down after 54. 55, a bear bar minimum follow through, but weak follow through. So there might be more buyers down here than sellers. But 55 is not a strong stop entry buy. And because of it, you may have traders selling it. 56, we have follow through selling for the bears. Good for the bears. Probably going at least a little bit lower. And then this was 56. 57, strong bear breakout closing on its low. Probably going at least a little bit lower. 39 low. We may end up testing below the 35 low as well. And then 58, a reversal bar, but a bear bar. Arguably, it's a pullback after 57, and it's testing yesterday's low 1. Not a good buy above, so probably sellers above the bar. But the sellers may not come in until we test the breakout point on 56. And instead, we went outside down on 59. 59, good for the bears. Still probably going at least a little bit lower. And then 60, you have more bears giving up. Looks like we're breaking out of the triangle and we're going to fall for some kind of measured move. 62, 61, another big bar, climactic bar. We may end up pulling back for a bar or two, but do you really want to be the first trader buying? Do you really want to buy 61 when the bulls have not had a bull bar closing above its midpoint since bar 53? Not really. 58 closed above its midpoint, but 58 is a pullback bar and it's not even a bull body. And then we have a doji 62, but probably buyers below. And you can see we basically got a small second leg down. And then we just drifted sideways to down for the rest of the day. Now, why did that happen? Well, we had the low 162. The bulls tried to get the reversal up, and then 66 was the low 2. When you get a strong breakout like this, closing below a trading range, and you get a low 1, it often leads to sideways trading, but then you get a low 2, and it leads to trend resumption. Why does that happen? Well, if you go to a 15-minute chart, This is 1400. That's 1400. That sideways trading is just one doji on a higher time frame. So this is a low one on a 15-minute chart. You can see it right here. Doji, that's the low one. For stop entries, I thought you could sell below 3 during 5 if you're quick, but fairly aggressive, or you can sell on below 5. You can also sell below 6, but not the best trade. And then if you do, you certainly get out above 9, or as 9 starts to reverse up. Bulls, they'll buy above 9, but again, this is a mess. I think a lot of those bulls will be pretty quick to scalp out in here. And if they don't, they'll definitely get out below 23. 23 is a double top with 11, and it's has a lot of overlap already, and that increases the risk that we get a reversal down. And therefore, always in bulls get out below 23, always in bears can sell. And what about 25? Do bulls buy? No. 25 is following a surprise 24, and therefore there's probably sellers above 25. It's the first pullback after the breakout. And 24 closed below the moving average, which is good for the bears. And then bulls, bears, some bears get out above 31, but I don't think they have to. Plus, it didn't trigger. They definitely get out above 35. Bulls, they can buy 35. Some get out below 38. If they hold, they probably buy again above 41 or 42. And then the bulls, and then for the bears, if they sold below 38, they have to get out somewhere in here. I thought 36 and 30, 35 and 36 were strong enough for a second leg. So I thought selling below 38 was actually lower probability because you're more likely to be selling into what's going to lead to a pullback and a higher low for the bulls. Bulls, they can be long. They probably get out below 48, certainly below. I think they definitely get out below 54, 55, 56. You're getting a breakout below the moving average, and it's a bear breakout below the bull flag. Bull flag, the high to the low, and then we're getting a bear breakout below. And the bear breakout started to grow and become bigger. And ultimately, that bear breakout, so the bears are short, they really don't have any reason to get out through here. And then where did those bears get out? And technically, they can get out above a bull bar, such as 73, because it's late in the day, or they stay short and they just get out somewhere down here. For limit orders, I thought there was probably sellers above 4, but you can see it didn't trigger. And then I thought buyers below 8, it didn't trigger either. There's probably buyers below 12, but there's also sellers above 12, so buyers below 12 during 13. And then I thought sellers above 15, but buyers below 15. I thought buyers below 20 or 20, buyers below 20. And then I thought sellers above 25. That was a reasonable trade after the bear breakout 24. And then probably buyers down here below 31 and 33. And then buyers below 40. I thought probably sellers above 49 or 50. And then definitely sellers above 58. And where else? That's pretty much it. You can argue selling above bars all the way down, but pretty tough to do. Buy the close, sell the close. Probably sell the close on 3, but I'd wait for more follow through. So sell the close on 5, sell the close on 6. But you got to be quick to make decisions, especially because most of the time, especially since most of the time, you get an opening reversal. It's fairly common. And one of the reasons, well, I'll talk about that in a second. So sell the close 6 and then probably buy the close 9 and 10, but you got to scalp out because we may test all the way back down here. I thought, instead of selling 24, it's probably better to sell a pullback and then maybe sell the close 29 or 30. But most of the time, you're better off selling pullbacks instead of selling closes. Buy the close 36 or 37, but better to buy the pullback. And, same really all through here. I thought probably sell the close 56, 57, 58, or sell above and then 60, 59 and 60, probably both sell the closes. 61, still sell the close, especially if you can use a wide stop. And I thought still sell the close during 67, 68, 69. But you've got to be really quick to make decisions down here. That can be pretty tough. One of the reasons you get the opening reversals a lot is if you go to something like a 15-minute chart. So this was 9:05, and you can see when we go to a 5-minute, leg one, pull back, leg two. So two legs down, and it's testing these lows right here. So the sell off to 9 to bar 7 is really a second leg down on the Globex chart. Monthly chart, someone asked, I made the comment that I thought there were sellers above. I think the market's probably going to pull back for a couple of legs. We're so far from the moving average that we're probably going to get there at some point. Even if we go sideways for a lot of bars, we'll drag the moving average up. I've got time to answer a few questions, and I'm going to wrap up the review. Use a 1-minute chart more to see more clear the parabolic wedges. I saw it more clearly today with the 1-minute, and it helped. Yeah, I mean, generally, I used to look at 1-minute charts a lot. One of the things I do, and I still do it today, is I actually have a workspace where I'll put a chart on the left, a chart on the left, and then a chart on the right, and I'll toggle the time frames. So, for example, if this is a 5-minute chart, I'll look at a 3-minute chart, and then I'll go to a 1-minute chart and look at a 2-minute chart, and then I'll go to a 10-minute chart and look at a 40-minute chart. And I'm just trying. The reason I do that, I don't do it during the market hours. I do it after the market as practice, better understanding what things look like. And so the more you start to see patterns, the more you start to understand that this is a breakout. So when you see 41 to 47, that's one big bull bar on some time frame, but you also know it's a parabolic wedge, and it's a spike and channel. When you see a bar like 36, it's probably some variation of a parabolic wedge from the 30. When you see bar 36, it's a parabolic wedge. But as far as the 1-minute chart goes, I think one of the dangers with parabolic wedges is they're great in this environment here. Like I said, parabolic wedge with 7, 9, and then 11. But one of the dangers becomes this, because on a 1-minute chart, you'll see this as a parabolic wedge, and then you'll end up buying on the 1-minute chart and getting trapped here. So I don't have a problem looking at a smaller time frame, but I'd really rather. I think the first thing someone should do that I think will benefit them, focus more on a 15 and a 5-minute, and really understand that this, even though this channel down's tight, looks like this on a 15-minute chart. So where do we go tomorrow? Well, tomorrow is actually the last day of the month, and at least last trading day. It's actually also the last day of the month, and it's Friday. We've sold off. This will be the 1, 2, 3, 4, 5, 6. So we have 6 consecutive bear bars on the daily chart. And the bears are hoping that we'll get a 7th. And the question is, there's 1 day left. And so the bulls, what do the bulls want? The bulls want to paint a tail on the weekly chart. So we have a sell climax here. It's possible that tomorrow is a disappointment bar. And if it is a disappointment bar, this tail on the weekly chart this bar on the weekly chart will have a tail. Even if it is, I still suspect it'll get a second leg down. I want to talk about the euro versus the dollar for a second. That is not the right day. There we go. This is the daily chart of the euro versus the dollar. And I think this is interesting as well. We had a rally up to the February 14th high. And then we basically formed a wedge top. So 3 pushes up, 1, 2, 3. And now we have a double top with the February 26th high and the February 14th high. We broke below the neckline on February 19th. And that's a pretty strong bear bar. And because of that, you always wonder, is this a double top and we're going to break below the neckline and fall for a measured move? We might. Now, what happens if tomorrow is a really big bear bar as well? Or what if we get strong selling on the way down? Then traders begin to wonder if this is a double top. So we have a double top with the February 24th high over here and this high right here. And, hypothetically, what if instead we break below this neckline really strong? That would take you back to below 1. And I don't think we're going to do that. But, who knows? It could certainly, this is strong enough to at least get a second leg down. So as far as buying it, I don't think it's really a great bar to buy. I think this is trapping bulls into a bad long. And so to me, that makes me think we'll probably get a second leg down. All right. So anyways, we will see with tomorrow. But overall, I think that it'll be interesting to see, will the bulls be able to get a rally tomorrow and put a tail on the weekly chart, or will the bears be able to sustain the selling? But we'll see. All right, thanks everyone for tuning in, and I will talk to everybody later on. Have a good one.